Hello, everyone, and welcome to another episode of the Property Trio. I'm joined, as ever, with my lovely co-hosts, Cate Bakos and Dave Johnston. Now, I want to throw to Cate immediately because she has some rather exciting news for the trio.
Yeah, we hit 400,000 downloads.
How's
Sensational. Amazing.
Yeah, feels good. We've been doing this for quite a while, us a bit longer than you, Mike, but, we've had our fair share of, putting our heads together and getting some exciting apps out there, and you've certainly joined the fold on that front, but we're very, very proud and very grateful to all of our loyal listeners and people that give us good feedback and feedback that says talk a little bit less about your weekends. Point taken. Yeah. Moving on, let's start.
Very cool.
Yeah. I didn't have a weekend. Did you guys? No, I didn't think you did either.
It doesn't matter.
Good stuff.
You can, so all the credit goes to you two and you three, I should say, with Pete Kalizos, who's obviously the godfather of the show, and I do tend to face Adelaide and pray every now and then.
You're
before
just the new
show.
Naughty rascal that's joined. That's all.
I am, yeah. Put me down for 10. So you guys did 390,990. But no, what a milestone. And we're going to keep going. So we'll see you at 500,000.
Yep.
So on that note, it's a market update show. So we're talking about the September data. A mixed bag of results. As a highlight, there's some changes to sentiment that are really interesting. But starting perhaps with you, Dave, looking at the CoreLogic monthly index, across the board, everything looks pretty healthy. Hobart, as we've been talking about Hobart for a while, it's in the doldrums a little bit. But from a high base, what are the takeaways for you?
Look, there's a few interesting takeaways. We're certainly seeing a correlation of listing levels with the capital cities that are outperforming versus those that are underperforming. So Adelaide, Brisbane and Perth are hovering around 40% below their 5-year average of listings. And no surprise, they are significantly outperforming. So Adelaide jumped a whopping 1.7% last month. Brisbane and Perth, 1.3%. Sydney at 1%, Melbourne just 0.4%, Canberra 0.2%, Darwin 0.1%, and as you mentioned, Hobart coming off a very long run leading into COVID, and then the other side of COVID, are just struggling to keep up at 0.6%. But they do have their listing numbers at 40% above their 5-year average. So as our regular listeners will know, there's a very strong correlation between price value growth and falls and listing numbers. It's possibly the strongest correlation there is.
Yeah, interesting. Very true. I picked up a couple of things in this chart as well, Mike. Namely, this is our 8th consecutive month of national growth, which speaks volumes, and it certainly correlates with sentiment and with interest rate movements as well, or dare I say no movement. And the interesting point for me is capitals versus regionals. If we look at the annualised wash up, combined capitals have done 5.1%, whereas combined regionals have only done 0.4%. But then when we look at quarterly and monthly, we can see that regionals are rebounding. And I've been chatting to our local regional agents, Ballarat and Bendigo and Geelong namely, and they've seen a bit of a turnaround. Things are improving. And I tend to find that Geelong is in slow step with Melbourne. Often when we have a turning market, they're usually a few months behind us, about 4 or 5 months, and we're starting to see that.
It's a shame with combined regionals that we don't have a little bit more data. Like, it would be great to segment that to combined regionals, except regionals within 100 Ks of a capital city, right? Because the market drivers are so fundamentally different. A bit like your, what did you say, Ballarat? Always get Ballarat and Bendigo. One's got gold panning and is miles away.
No, they're both gold panning. Just a little fun fact, Bendigo has more gold, has produced more gold and has more reefs and more mines than Ballarat. So they're all in the Golden Triangle.
We need like a Property Trio roadshow where we can get a bit of prospecting in and hit the big time.
Hey, you just name it. You've got the plane. You come down and we'll go up there.
Righto. This technically qualifies as banter, so I'm going to have to give you a yellow card.
But I think it's a great point, Mike. It would be, I think, having those mid-tier cities as a grouping. So we have the capital cities grouping, And then we have regionals. But I think, the fact that the Gold Coast and the Sunshine Coast are included in regionals, for example, is really a distortion.
I'm with you, Dave.
Yeah.
And I think anything that is driving distance to the office, like reasonable driving distance, and let's put that in perspective. I think if you're prepared to live out in the suburbs, in the fringe areas, and catch the train or drive in, and that's home for you, you're saying that you live in a capital city, but you're more than an hour away. Well, if there's a nearby region that is about that distance, to your point, it will perform very differently to something that really is a remote region that doesn't offer easy commute or amenity.
Yeah. Look, another interesting thing with the regionals is there is the Victorian, regional Victoria and regional Tasmania are exceptions where advertised supply is above average, whereas rest of the regional areas supply is below average. So in terms of listings, so that's sort of putting a bit of a bottom underneath some of the regional markets. So, but I wonder what's causing. I wonder if because the lockdowns in Melbourne were the strongest, if there was a bit of. We know there'll be an outflow into regional Victoria, and potentially buying of second homes, and I wonder if that sort of flowed down to Tassie a bit as well, because they're the two regions where supply levels are above, in terms of listings, are above average. Do you two have a theory on that? So regional Victoria, regional Tasmania, the only two regional areas where listings are above average.
Yeah, I do. We had a mass exodus. Melbourne was the toughest lockdown city in the globe, and lots of people left. Now, a lot of people did go down to Tassie, and for affordability reasons, they did target the regions in Tassie because you could pick up property for a peppercorn compared to anywhere else. I remember years and years ago looking at little places around Tassie that most people wouldn't have heard of, and you could buy property for under $50,000. Now, that admittedly was a long time ago, but that was back when peppercorn prices in Victoria were maybe circa $150,000. So it doesn't change. People were looking for an alternative, and it was affordable, and it didn't matter if it was remote.
And reasonably open, not very locked down, which was
that's right. As long as you had good Wi-Fi, you could work. So we saw people throwing caution to the wind around accessibility and commute distance and amenity. All they really cared about was just not being locked down in Melbourne and being able to sit on a farmlet or have their garden, go for walks, feel the great outdoors and not be scared about the pandemic or being locked down. And as a result, we're now seeing people coming back. Our cities come to life, and we've been saying this for a long time. People are being called back to the office, and life can be lonely when you're remote and everybody's bouncing back. And I've said it before, if Melbourne loses 0.5% of its population, it doesn't make as massive a difference as if that same physical number of people leave a small town or leave a small region.
A bunch of small towns,
Yeah.
There's a little place in Tasmania called Baghdad I went to once before. I did a little video there saying, like, this is why you just can't trust the media. Like, I've been walking up and down the street, like, there's nothing going on. Like, it's the safest place on earth.
Yeah.
Slightly different.
Down on the Derwent.
It's good old the safe streets of Baghdad, hey?
Safe streets of Baghdad. Yeah. A slightly different spelling. I want to ask you guys, because I've probably missed, 399,000 downloads of this show where you guys were talking about the correlation between price appreciation or depreciation and listing volumes. I've run some analysis before and found a correlation between price appreciation and listing volume. So we actually need turnover, but presumably there is a sweet spot where there's so many listings available that there's a lack of competition. It seems like at the moment listings are on the increase, and that's kind of releasing people because they've got somewhere to buy and people are selling for more than what they paid for. But have I got that right, that there's a sweet spot, and when the listings go too much, then we'll actually see falls?
Yes.
Yeah, I think that's likely, and I think we're certainly seeing listing numbers grow in Sydney and Melbourne. So I think it's a watch this space with the two majors. I mean, that and again, we're talking short term with our market updates. Long term, I still think they're absolutely great places to be, but we're certainly seemingly going through a period where people are feeling more confident to list their properties now that we've had 4 rate pauses.
There's 2 interesting factors at play here, and I was the first person. Well, I shouldn't say it like that. I was saying if we have a lot of listings this spring, it might give rise to some opportunity for buyers. They might see prices remaining stagnant or falling. And I've been proven wrong. And the reason for that is we've had a lot more buyers jump in, and we'll talk about the consumer sentiment going forward. We've had interest rates on pause, which means people can take stock of their borrowing capacity and buy with confidence because they're not about to have their borrowing capacity undermined by another rate increase. We've also seen vendors creating vendors. And what I mean by that is that chicken and egg issue where someone says, I'm not going to sell unless I've got something to buy. Well, now they've got something to buy and they're selling. So we've had this really nice ripple effect of listing activity. And we've had buyers that have jumped in and soaked it up. And we've had a lot of people transacting. So I'm interested to see what comes out in the data. But from anecdotal evidence and my experience at the coalface says that people are buying and selling. It's not just new home buyer activity. We're getting upgraders and downsizers making moves, which is great.
It does seem intuitive that if there's a flood of listings, a spring selling season, and that people will be spoilt for choice, and that's going to keep a ceiling on prices. But it seems like there was so much pent-up demand and some structural inefficiencies, i.e. people perhaps wanted to sell, but they had nowhere to buy, so they were sort of holding off, and of course the interest rate thing as well. So I wouldn't be too hard on yourself, and I think it's nice for people, when people say, you know what, like I put it out there and I've learned something from it. So good on you for your humility on that one. I certainly have made a few bloomers myself. Rents. Let's talk about rents. There's been talk about rents sort of moderating. However, vacancy rates are galloping away. I wonder if the moderation is rents is just reaching that point where people are going, you know what, I'm moving back in with my parents, or I'm getting a flatmate. It's not that there's more supply coming on; it's a structural change. Dave, what's your take on that?
There's actually, I don't know if you've read the data, but there's data coming out suggesting that. So formation rates are changing. Something, we spoke about a number of times leading into this, like 12 months ago, that the number of people living in a property is increasing, and that's changing the outcomes, and so that's why rents can still slow. So I'm just trying to find some of the information I have on that here. But in terms of the overall slowing pace, the last quarter rents only increased across the nation by 1.7%. Sorry, the combined capital cities. And the previous quarter was 2.7, and the quarter prior to that 2.9. So, there's a noticeable slowdown. And it seems counterintuitive at a time when vacancy rates are tightening. However, it's probably a signal that rental affordability constraints are forcing a structural change in household formation. As group rental households reform and renters seek to maximise their tenancies in an effort to spread rental costs across a larger household. So, data released by the RBA earlier this year shows a rise in average household size, following a drop in the average number of persons per household during the worst of the pandemic.
Okay, do you think that
you nailed it, Mike?
Yeah, good. Cate, do you think the politicians will see this data and go, "Oh, see, we're solving it"?
Of course they will. Absolutely. The Greens will say, "See, we told them." What I will say, and to support Dave's point, I had a journalist call me to comment on a story that they were writing about the dominant search terms that they're saying introduced to people's searches online. And one of the top ones was granny flat or self-contained. Right. And people are looking for opportunities now to have family or friends, generally family, living with them. And of course that will have a knock-on effect to the rental demand as well. But before we say the problem's solved, let's talk about our 2 biggest cities and where houses are looking at the moment. So if we have a look at these charts, we can see some of the peaks have come off a little bit, but Melbourne's still pointing to the sky and Sydney's had an uptick for houses. Now, it is a tough market out there. Chat to anyone who has a family and is looking for a house. It can be a little easier for a single who's looking for a unit to think, okay, I can just house share. But families find it a lot harder. It's almost impossible to house share with a family.
100%. And as you get older, you're not as happy or comfortable, even if you don't have a family to house share as well.
Yeah,
I mean,
you get
it's
set in
different.
your ways.
Yeah, when I was like last
you'd
year
be a
uni and
grumpy
we were all
flatmate, Dave,
moving
wouldn't
out, moving our girlfriends in, and we had
Yeah.
5 or 6 of us in the property to reduce rent and save up some cash. But it's a bit harder as you get older, you're in a family, or you've got a grumpy housemate.
Yeah, you need your ointments lined up just so, you don't want people touching your talcum powder. When we say that I'm just imagining your medicine cabinet, Dave.
Oh yeah, I'm big on medicines.
When we talk about rents moderating, I mean, across the average houses and units, Sydney and Melbourne, we're still talking double-digit growth annually. So it's not a solved problem by any means. I don't know. I just get that sensation that the politicians will not necessarily look at the data and see that we're seeing structural changes, but we're actually going, oh yeah, okay, it's getting better, and it might be to the point where the average household has 11 people in it, but then the vacancy rate's 2% and rents aren't going up. And they're like, go us,
Yeah, we
go
nailed
Canberra.
it.
Yeah.
Yeah, look, I think it's unlikely for there's too much of a structural issue, so much undersupply. I think the pressure is going to stay on the politicians.
I do
even
too.
with the rental increases slowing down somewhat in most areas, but not all.
Yeah,
Because we're hearing those stories, aren't we?
We are. Like, aside from the strugglers, the ones that have come off a little bit, Hobart and Canberra, we're still seeing, for units in particular, Adelaide is 9.8%, and then Melbourne, Sydney, Brisbane and Perth are above that. If we're saying, okay, well, things are slowed down, thank goodness, we're only paying 16% annual increases. If that was capital growth, we'd be talking about it, in a very different manner. 16% growth for a tenant, it's a really hard burden and a hard increase to weather.
Yeah. And look, I mean, the actual vacancy rate's dropping to 1% in capital cities and 1.2% across regional Australia. It's actually the record low for the CoreLogic series, which commenced in 2006. So I think that headline's not going away anywhere. And actually, it was just interesting. The pre-COVID average for capital city vacancies was 3.1%. When I think, Mike, you asked us what our understanding was of a balanced market. And historically, our understanding was around 3%. That's sort of what you grow up under. Well, it turns out that's actually the historical average is 3.1% on the CoreLogic numbers.
There you go. Nailed it.
But Domain actually has their vacancy rates at 0.8%, even below 1%. And interestingly for you, Mike, you would need to have the whole local government area of Newcastle, every single property come online for us to get up to that 2 to 3% average vacancy rate. So that sort of puts some perspective around how many new properties we need
Newcastle's
to get back to
largest regional centre in the country. I mean, I'll make some calls, Dave. No promises. I don't see it getting done this afternoon.
Spread the word, will you?
Yeah, I'll do what I can.
What's the population of Newcastle?
I think Greater Newcastle, including the Hunter Valley, is about 750,000. Newcastle, for last guess, was high 300s, something like that.
Similar to Geelong.
That puts some perspective around it, doesn't it?
Yeah, could be a little bit more. Don't quote me. What you can quote me on is gross rental yields. If you're chasing yields, you want regional Northern Territory. Is that investment advice, Cate?
No, it's not. Because there are markets within markets. I could find you 6.7% in Melbourne if you really wanted it. And would it mean it's a good quality asset? No. And would it mean that you'll net a great return? No, because you'll have other things that will be eroding that. But as a whole, gross rental yields have climbed remarkably. And I look at the two cities that were always well known for delivering poor rental yields, and they were Melbourne and Sydney, for both above 3%. I never thought I'd see that day.
It's unusual, isn't it?
Yeah.
Yeah, it's good to see that. I remember when that was commonplace, sort of 10 to 20 years ago, but they just gradually kept declining because capital growth outstripped rental growth for the past decade, which we've talked about. And So it was good to see yields start to recover. A lot of younger people and property experts had never seen yields increasing in those capital cities and thought they just forever reduced. And I saw people's modelling who just had yields, over long-term modelling, just forever reducing, which just doesn't happen. They do come up and back. They fall and then they increase again. So but once again, capital growth is outstripping rental growth in most locations, so yields are starting to reduce once more.
And we chatted about this a couple of episodes ago, and I'll say it again. It's great when you can get started with a high yield, if that's what you need, and sometimes you have to go for a higher yield because your lending requires it, but you just have to hold your property for long enough and look back at something that was delivering a horrible yield and it's now delivering you good growth and great yield. Time is your most powerful ingredient when it comes to yield.
Yeah, you look at your portfolio and you go, oh, that one's got a yield of 11%. You're like, oh, okay,
yeah, it's
right. You just need a bit of time, you need a little bit of patience. All right, so let's move on to 12-month change in rental rates. Kate, you've highlighted some very, very interesting ones, and Perth is a real standout. Now, I want to put it to you guys that we actually do a bit of a featured episode on Perth because I've got some very interesting new data and also some historical information about the Australian Constitution and Perth's, WA's unwillingness to be in it. So that could be fun. But Kate, talk to us about Perth.
Okay, well, I saw this come out from CoreLogic just yesterday, and it was an interesting insight, a data pack on rents. And we've got a 12-month change in rental rates, and Perth is soaring. In fact, for houses and for units, it's leading the pack. But then when we have a look at the 10-year change in rental rates, Perth isn't doing so well. It's the second worst for both houses and units. And what it goes to show is that we've got some capital cities that are a little more volatile. And when you're looking at monthly change or quarterly change or annual change, sometimes that isn't even enough. And that was my case in point with this chart.
Yeah, 100%. It's a really great observation. Perth, sure, 12.7% over the last 12 months, but it's only grown by twice as much in a decade.
And let's look at Hobart. That's another good illustration in this chart. Hobart and Canberra are the only two that are delivering negatives for houses and units. Hobart looks pretty dismal, but when we have a look at houses and units over 10 years, Hobart's number one for houses and number two for units.
That's interesting, isn't it? Because the investors will talk about timing the market versus time in the market, and they say, "Oh, well, like it's like that little Spanish girl with the tacos. Why not both?" Yellow card for myself for banter. But people are definitely drawn to picking the hot spot of the moment, and the anecdotal evidence on the ground in places like WA, and it's a bloody big state. I'm talking about in and around Perth, where there's been an absolute investment gold rush. There are properties that are listing and getting multiple offers within about 5 seconds because it's shown some really great fundamentals in the short term. It's at that point where it's the second most affordable capital city after Darwin, and everyone is a bit afraid of Darwin volatility, and a lot of people are thinking, look, Perth is going to perform. If you bought in Perth 18, 24 months ago, you've probably made quite a lot of money. If you're buying in it now, I worry that you're buying the top, and as this data is showing, you might see some good results for 12 months, but then you might see nothing for a decade. Am I just a wet blanket, or is there something in this case?
I think you've got to look at how cyclic some locations can be. And I've said it before, Hobart, I didn't time it right when I purchased. I've held it for a long time and it's delivered. But there are some cycles you really need to be prepared to sit through. And I think these two really nail it. And we know what Perth did or what Perth didn't do for a long period of time. So I hear a lot of people talking about jumping onto Perth now, but unless you're transacting in property, you're trading in it, which we don't recommend, I would say that looking at tiny movements of, performance is a really dangerous thing. You've got to be prepared to look at the bigger picture. And I would even argue that sometimes 10 years isn't even enough.
There'll be a whole generation of Perth investors from about a decade to 15 years ago who are absolutely scarred from their experiences.
Totally.
And so it'll be a new generation of investors who are getting in on that bandwagon again, in the hope that they're going to pick the run and pick the winner. But yeah, I think they're underestimating the significant risks involved with that market.
And the things that people get upset about when they do jump onto a bandwagon and it doesn't perform is lost opportunity, because they're looking over their shoulder at other performers thinking, I could have got a piece of that. So diversification is important, but speculating is really dangerous.
And I vividly recall when Perth was the next big thing, and every man and his dog was talking about Perth and buying in Perth, and it did. It felt like crazy. Boy, this is it was flying, and it looked like everyone was, making great investment decisions, and everyone was high fiving. It was like around the .com bubble when before that had burst. I remember, particularly say the owner of the business I was working where I set up the mortgage broking arm, and he'd show me a spreadsheet every day and how much his shares were going up. And I always remember the name of this one company, SecureNet, and how it was flying, and then it all just fell in a heap. And it was this very similar thing with Perth, and we've had a decade before it's finally got back to its peaks of over 10 years ago.
Yeah,
we've also got a little bit of data on median rent in most expensive versus most affordable suburbs. So Vaucluse is no surprise; it's $2,500 a week to rent, whereas you've got Tregear. Never even heard of that place. 487. So that's where you're getting your value. And a big shout out to Melton, which I think I said disparaging things about. I mean, I've never been to Melton. It's probably a lovely place. In fact, rents are very, very cheap. $395 a week compared to Brighton, or as they like to call it, Brighton.
Yeah.
I've walked every street in Brighton. $1,361.
I throw this one in because it is quite intriguing, the differential between the top and the bottom. Perth and Melbourne and Brisbane have a bit of disparity, but Sydney is just frightening. The fact that you could rent something for $487 a week or $2,588 a week, that's an enormous discrepancy. And it just shows there are markets within markets, and we cannot generalise a capital city.
Yeah, I can remember being a young quantity surveyor inspecting a multi-million-dollar unit. This is some like 10 or 15 years ago, perhaps, and there was a lady in there, and I knew that she was paying $3,600 a week in rent, and I just sort of I thought, what do you do? Thankfully, she told me she was an artist. She was a Canadian artist, and I just made me realise I don't understand how the world works.
She sold some good paintings.
She sold some good paintings. She sold some original Da Vinci's that she probably counterfeit. I don't know. I don't want to put a slight on Canadians, but it's crazy, isn't it, to think that people are spending that amount of money on rent, and then you've got people that are trying to make ends meet on $400 a week. It's an interesting situation. Let's talk about another interesting situation where the Worm is doing some interesting stuff on the new listings, especially the rolling 28-day count on the combined capitals. Cate, I know that the listings have been something that you've been keeping an eye on for a long time. Is this the spring selling season that we haven't had for the last couple of years?
Yeah, it is. It certainly is trending up. Last year we had a really unusual year where we had more listings in winter than spring. This year we've got more listings in spring than winter. We've also overtaken the 5-year listing average. So for new listings, it's healthy. It's looking good. For combined total listings, though, we are well under last year and we're well under the 5-year average, which means that as much as we have new listings coming out, we have a lot of buyers soaking up those listings.
So the difference is it's sort of like a days on market calc. So if they get hoovered up very quickly, then it's not going to find its way into that. Is that how we should read
Sort
that?
of. They're not only being hoovered up quickly, but buyer demand is so strong that they're hoovering up stuff that's been on the market for over 180 days. So we're eroding our total stock volumes because we have much stronger demand.
That's interesting, Dave. I've read a blog where Cate talks about the investment grade stock bar sort of lowering at certain times in the market, where you get these properties that are a bit of a lemon, they're on a main road, and then they start selling because there's competition in the market. Do you think that people have got a little bit more confidence with interest rates on pause, and it's now kind of buying season, and because of that tightness, they are sort of looking to these B and C grade investments?
Look, I think that definitely happens when you've had a lower level of stock, that people will sort of strain or stretch their parameters of what they accept as a property that they'd be willing to purchase. I think even like if you look at the number of property professionals and buyers agents, the proliferation that's going to, when we had a buyer's agency, I reckon there was about 3 of us in Melbourne like 20 years ago. There's thousands around the country now. So, not everyone can be buying the highest quality stock. So it's naturally going to spread, and the standards that people accept versus reject is just naturally going to get lower, and so that plays out with some of those numbers.
Yeah,
and
over time.
And this is maybe an aside, but I think it's worthwhile consumer advice. In the buyer's agency space, you've got some more boutique style people, and I would say Cate fits into that. And boutique doesn't mean unsuccessful; it just means more dedication to the individual transaction, where there are volume people that they really just need to be doing 30, 40 deals a month. And it begs the question, when stock is kind of tight and they've got to keep the lights on, is there an incentive to be purchasing what they would consider B and C grade properties? I don't know if anyone wants to go on record on
just
that.
Just go and read Freakonomics. Nearly every profession has incentives, and it's just human nature. It's sociology. So 100% there is, and that's why, as a consumer, you need to be really careful about who you select to be buying property for you, or any profession really, because what's Paul Keating saying? When always vote on self-interest, it'll top everything else. It's a butchered version of his famous saying, but
it's a fair point. I think you've got to be prepared to say to your clients, we're going to have a slow winter. And if anyone polled any of my clients that I've worked with over winter, I always say to them, we might not be buying for you for July or August, and we'll just be best friends for a lot longer. You have to factor that into your business model, that there are some months that you don't want to push the limits. And if the right property and the right price comes along, great, that's fantastic. But anyone who opened my books and had a look at my acquisition rate, there are months where it's very, very slow, and that's a good thing. I feel quite pained when I see on Instagram, some buyers agencies that have purchased something off market, and they're high-fiving themselves. Oh, we found the unicorn and there's no stock. And I look at the off market and I think, I remember rejecting that. You do have to be prepared to say no to properties when the selection isn't great, because buying a lemon for the sake of buying is not the aim of the game.
No, it's not your fiduciary responsibility to your client. Now, we put out a podcast about the mortgage cliff, and I think I called it a mortgage sort of slight downhill. Has the distressed listings information made egg in our face come into alignment?
Not really, because the numbers are really low. And even though they've jumped a bit in particularly the 2 states or cities or Tassie and ACT, where it's feeling the most pain, they're still very low bases at this point in time.
And to just jump in there, Dave's point is great because I look at the listing activity as well. Let's talk about Tassie and ACT. It looks like we've had a significant yearly change, but we are talking about stock volumes. I'll just quote it. September 2022, total distressed listings for ACT was 16. And for September 2023, it's 20. So I'm looking at this saying, oh my gosh, Canberra's looking 25% worse, but they've got 4 more distressed listings than what they had 12 months ago. I just want to put it in perspective. The data set is tiny in those two states.
Yeah, 100%.
Now, all right, consumer sentiment. Now, I prefaced this in the beginning of the show in lieu of banter because we've had some feedback.
Well, it's on the opening. We can have some banter throughout the episode.
Yeah, if there's no banter throughout the episode, I'm out.
Yeah, exactly.
It's not because I won't. It's because I can't. I can't not. I need to talk about Baghdad and visiting and it being quite a peaceful place.
Melton.
Consumer sentiment, October 23. We've got 82.0 as distinct from 79.7 in September. 83 in October the year before. So we're still kind of in the doldrums, but there's green shoots, would you say, Cate?
Yeah, there's a little show of optimism, a little show. But what I was really surprised by is toys, time to buy a major household item. We've ticked back up. So we've had 4 consecutive months of rates being on hold and we've just gone, yay, let's, buy that new dishwasher or whatever it is that we like to buy.
Yeah, look, I mean, the time to buy a dwelling index, what happened with it? Did it have a slight rise to 76 points?
Yeah. It went up 4.8% for the month.
Yeah, so that's heading in the direction we would have expected it to have been moving in for a little while. And then also the house price expectations index jumped to 160, so rose a further 3.8%. So that means just under 70% of consumers now expect prices to rise over the next 12 months, which is a pretty high number. But interestingly, in the state breakdown, the big jumps are in Queensland and Western Australia. So Queensland jumped by 13.6%, Western Australia by 29% in terms of the number of people who expect prices to rise in the next 12 months. So obviously sentiment's really strong there for property price growth.
Bit of a confirmation bias there as well, I think, because they're watching it go through the roof, but it can't last forever.
Yeah.
Whereas like New South Wales and Victoria were broadly unchanged. So the sentiment's sort of stabilising.
Yeah. I saw another poll, ANZ, Roy Morgan, Consumer Confidence, and the headline observation was that consumer confidence has reached its highest level since Feb 2023, marking the end of a 31-week period below the mark of 80. So,
interesting.
well, yeah, look at 80
Maybe
still doesn't suggest
hope.
Yeah, it certainly shows a little bit of a turnaround though, doesn't it?
Yeah.
What about lending? Lending seems to be pretty poor. We've seen an uptick in the last month. So this would have been August data, I believe.
Yeah,
that's right.
Where, housing is down 9.4% over the year, 12.5% down for owner-occupier and 3% down, but we saw a 2.6% increase in owner-occupier and 1.6% in investor. I wonder how much of the interest rates situation has sort of factored into that, but then I suppose with that being August, it can't have.
Yeah.
Yeah,
it's annoying that we've got that data lag, isn't it?
It'd be pretty early on for that to have had an impact, wouldn't it? But some initial adjustments there. I mean, overall, the percentage of owner-occupiers versus investors is staying pretty around historical averages. So it's 64.7% of purchases owner-occs versus 35.3% investors. And the historical averages are basically 64 and 35 as well. So we're still having a similar mix of owner-occupiers to investors. But in terms of construction, In August 2023, there was a rise of 17.2% for business construction, but it's still 5% lower than a year ago. But hopefully that's a little bit of a sign that businesses are starting to come back and be willing to build. One thing I saw just recently is the cost of construction, building costs, has come right back down. So that's really good signs in terms of that was one of the big aspects of pushing up the cost of housing and slowing down the new supply of property. So
it's encouraging, isn't it?
It's encouraging.
Yeah, it's still outpacing inflation, but it's moderating. And Cate, the index that almost sounds like a BACOS index.
Yeah. I tossed this in. I liked it because it just shows a dramatic decrease in freight cost, which has a complete knock-on effect to building materials and other things.
Yeah, of course. I mean, the majority of our building materials do come from overseas, so freight costs make a big difference. We've seen freight costs go back to what they were pre-pandemic after a huge spike, but we still have construction cost pressures in the market with labour shortages. Even with us, I think we had a tiny uptick in unemployment, which will feed through to the labour market a little bit. But I suppose immigration is more the story that's going to move the needle there, which is exacerbating the housing issue. So there's going to be some political debates about that. I'll hand it over to you guys in closing for either your gold nuggets or a data point that I've glazed over that you really want to share.
Well, look, Dave, just a little bit on inflation. So the August numbers came out, and so core inflation was down to 5.5 from 5.8%. So that was good, but headline inflation actually increased. And so just something for our listeners, the markets are still suspecting sort of around 50 or slightly above, there's a possibility of another rate rise. So the most significant price rises were insurance and financial services was actually the highest, which is a bit of a concern. Obviously, all of us pay different insurance premiums, and some of that will be attributable to climate change and the greater risk that's happening with weather impact.
Don't you think most of it would be? I think the vast majority would have to be apportioned to that.
A big chunk of it, no doubt. Transport was also high at 7.4%, although building material costs were slowing down significantly, as I just touched on. Housing is still quite high at 6.6%. And then food and non-alcoholic beverages at 4.4%. And as I've touched on a while back and a couple of times, what's now proving the problem is services inflation is remaining sticky. So that is, businesses are charging extra to recoup their costs and people are still willing to pay more. So that's as I've touched on previously, the similar in the US and Europe and other places. So look, Michelle Bullock. Michelle.
That was so Freudian. I love it.
Might need to make a very difficult decision and raise rates potentially one more time if this holds. So hopefully it doesn't, but yeah, there was a few little risk indicators in this August month's numbers of inflation.
Yes, we could really see a rise next month. It's definitely on the cards, where it sort of seemed a little bit more biased towards a hold. Time will tell. Cate?
Traders hate it. They hate the November rise. They really do, because it hurts Christmas sales.
Yeah, I think I feel like she'll try to hold off until early next year if she does do a rate rise, but the numbers will tell the story, won't they?
Well, indeed.
There are prices moderating. Apparently, energy prices have come down. I couldn't tell you why. Oil has come down, although there is a little bit of a blip.
Is still expensive.
Spike in petrol.
Yeah, it's not flowing through.
What is going on? I'm not cool with $2.20.
It should be coming down, but then of course we've got the Israeli conflict, which is a horrible humanitarian disaster that's going to put some uncertainty into the market. But apparently, it's all about the Strait of Hormuz, which is fine. So oil should continue to do what it's doing. I'll go to some gold nuggets or some takeaways from you guys, starting with you, Kate.
Yes.
Now it's time for us to go mining for our gold nugget property tip of the day.
Okay, I do want to chat about the Freightos Baltic Index, which you alluded has come down significantly, but just to put some context around that, it's decreased by 62.3% than the same week in 2022. That's an enormous differential. So we can anticipate that the cost of goods that are freighted will continue to come down.
Look, as I touched on the other month, we're likely to hit new highs for the median national property value and it's looking like towards the end of November. So since finding the trough in January, the national index has recovered 6.6%, and home values are only 1.3% below their record highs of April last year now. So looking like we'll hit the new record high around the end of November.
Do you know something really compelling about that? When you look at the series of downturns that we've had over the last, I think it's 3 decades, the one that we've recently had was the sharpest and the shortest. So it was the most aggressive, and we had the biggest fall, which is hard to believe until you see it on the chart. I'll pop that in the show notes. But it just demonstrates that when you stand back from the static and you look at the chart from a distance, it looks very, very different to what we all panic and see doom and gloom reports about.
Yeah, and as you look at it over the longer term, they look like they go for such a short period. And actually, that is a trend that I've spoken about before on the podcast, that the falls are tending to be faster and
shorter,
further, but not as long.
And it definitely was further, but not by much, right? Like if you look at that graph, you'll see the low point, and it's not significantly different. We didn't see any of these 30% predicted price falls. And I think structurally in the Australian property market, we're unlikely to see double-digit price falls on any regular basis. But anyway, time will tell, and November will be very interesting as we head to the RBA decision. And then, of course, we've got the referendum and all sorts of things happening in the space. So we will keep your finger on the button in the next little while. But it's a big thank you to Kate and Dave for our market update, and we will see you for the next episode.
See you
next
later,
week.
guys. Bye.
Bye.